Joining me in studio for his take on what all the data is telling us, Azar Jammine, Chief Economist at Econometrics. Azar, thanks very much for coming in today. Is it a foregone conclusion that rates will be cut this week? Because we had Reserve Bank Governor Jill Marcus speaking last week and saying nothing should be taken for granted.
Well, Jill Marcus has to say that as governor, but I feel that this is almost a certainty, the rate cut. The barrage of data that were released over the last 3 weeks pointing to relative weakness in the economy, fairly significant disinflation, as well as the recent strengthening of the rand and the cut in petrol price, obviously, all point to the likelihood that interest rates will be reduced. If the Reserve Bank doesn't cut them now, it may not have another opportunity for doing so, and there's a lot of pressure on them to do so. In the past, it was really the trade unionists and big business exporters who were calling for the interest rate reduction to help the consumer on the one hand, in regard to trade unionists, and to help exports weaken the rand and help exports on the other. But now one's finding economists themselves are calling for a rate cut.
And we had some business organizations last week also, Saki, I think, or Busa, coming out and saying that rates should be cut.
Well, one would expect Busa to say that because, of course, many of their members are exporters and they see a cut in interest rates as a means of diffusing some of the upward pressure on the rand. But I think more generally, people just feel that if inflation's 3.7%, and on the way down, and the rand is so strong, there's very little to lose by cutting interest rates. That is the common perception, and I think the Reserve Bank will not get much criticism for cutting interest rates now. In fact, it may well be criticised more if it doesn't.
It does seem to be counter-cyclical, though, because we have other banks in similar economies raising interest rates, and some of them have been raising interest rates for some time now, yet we seem to be going against the trend.
Yes, and that's precisely why I think that we may not get any further interest rate cuts, and why we've got a window of opportunity now to cut interest rates. The other thing one has to bear in mind that many of the countries who have raised interest rates are experiencing fairly robust economic growth, which is not the case in South Africa at the moment.
Well, do you think the case is building for 100 basis points to be cut from our interest rates, and do you think that's likely? At the moment, we have a real interest rate, and you talked about growth. I think growth coming in 2.6% for the first half of the year so far. We had inflation 3.7%, so a real interest rate of about 2.8%. What do you think cutting interest rates by maybe 50 or 100 basis points would do to growth going forward?
I don't think it would have a dramatic impact on growth. I mean, this is the story worldwide at the moment, with personal debt levels that's so high. Lower interest rates are not infusing more growth, because people are just using the opportunity to retire high levels of debt and of being much more cautious. But little by little, of course, it means less interest payments every month, and in the long run that should help financial solvency. But it's not going to create a huge boost to economic growth. But at the same time, one's looking for balance, and in the context of the current indicators, it seems to be a fair call.
Well, what sort of growth are you looking for this year now? Because we had, just a couple of months ago, we had regulators, we had governments talking about 3% growth this year. Lots of economists also quite bullish on that. But as we progress throughout the year, it looks like it's starting to slow a bit more than expected. Of course, we had second quarter growth at 3.2%, and that was against expectations of 3.6%.
Yes, of course, one has to be a little careful. The second quarter growth figures were softer mainly because of one single number, and that was mining production was awful. But of course that does form part of the picture overall. One's also getting anecdotal evidence of softer than expected growth in construction since the ending of the World Cup. And the figures that are available on retail sales and accommodation in June show that the boost to spending from the World Cup was not quite as great as it might have been expected. So I'm beginning to think growth could well come. We'd be lucky to get 3%.
How do you factor the strike activity and some of the wage settlements into the MPC's decision making this week?
Into the MPC, you know, I struggle to find out what, in my own mind, to actually analyze what the full impact on the economy, certainly in the short term, is going to be. because you can argue that because the strikers are going to get higher wages, that will boost their spending power in the short term, which will boost economic activity. On the other hand, there are those who say, no, but they're going to lose, they will have lost wages by being on strike, so that's less purchasing power. A lot will depend on whether the government says, all right, in order to get an agreement together, we'll agree that we'll pay you out for the time that you're out or on strike. So it's not at all clear what the final impact on the economic growth will be.
How about the impact on inflation? Of course, we had the latest CPI reading at 3.7%. Do you see this being mildly inflationary going forward? Don't you think it'll factor very much at all? What's it going to do?
In the short term, I don't think it's going to factor very much because money supply is hardly growing. All that it will result in, and government has almost hinted at that, is that it might reduce its expenditure on other programs in order to finance a bigger public service wage bill.
Just looking forward from here, of course, we have the deteriorating situation in Europe at this stage. This is something that Jill Marcus has spoken about in the previous two MPC decision announcements, where that was one of the big risks going forward. Do you think it's going to factor again? Do you think it is getting a lot worse, that we may have to see another interest rate cut even later this year?
No, I don't think it's getting a lot worse. You've got to be, if you look at more recent economic indicators internationally, they seem to be, well, they've lost the momentum of strong recovery, but they are not weakening that dramatically. You've got to bear in mind that there was such a massive stimulus over a period of time in 2009 that the lag benefits of that are still filtering through. So I don't see a major weakening in global economic activity. And I think the relative strength of stock markets around the world are tending to discount that as well.
So 50 basis points on Thursday?
Yeah.